Recently, Todd Combs, one of the top investment executives that works directly with Warren Buffett to manage their multi-hundred-billion-dollar investment portfolio, he revealed in a conversation the three-step approach that he uses working directly with Warren Buffett to share their screening process. When he meets with them on Saturdays on the weekend, sharing, hey, these are the stocks. This is the three-step approach we use to find exceptional investments. So in this video, I'm going to share their three-step approach that they use, why they use it, the pros and cons. And if you enjoy educational investment videos, please make a point of hitting that subscribe button. So let's understand the three steps. The first step is actually quite simple, saying, hey, I want to find a company that's under 15 times a price to earnings multiple over the next 12 months. Now, the way to think about price to earnings multiples is that saying price to earnings, where you're saying you have $15, let's say, of market value and $1 of earnings power. And I personally prefer looking at it on an earnings yield basis, or earnings divided by price, where you just flip it over saying 1 divided by 15. Once again, that $1 of earnings divided by the $15 of market value. And that gets you to around 7% yield. And the reason why this is important is if you think about an investment saying, hey, if management returned 100% of their earnings power to you over time and it trades at 15 times, then you're getting a 6-7% yield. That's how to consider thinking about it. And then if you get, let's say, GDP growth of 2-3% over time, you're getting, 6-7% plus 2 or 3%. So now you're getting closer to that 10%. And 10% is historically the yield, or the hurdle that Warren Buffett was looking for, arguably much higher when he was managing smaller sums. But now that he's managing hundreds of billions of dollars, this is sort of the hurdle threshold. But he's saying, hey, at a minimum, I want to be able to pencil out 6-7% plus a little bit for growth. So that's really important to consider. First saying, hey, I want to cover my downside. The second key rule that they followed is they wanted to make sure that the business had more earnings after 5 years. He wants to make sure the fundamentals are there. This business is getting bigger. So it's not surprising to see that Warren Buffett, it's quite interesting, in my opinion, to see Warren Buffett's Berkshire Hathaway recently make Taiwan Semiconductor a $4 billion purchase for their portfolio. And here's what Taiwan Semiconductor is saying they're entering a period of higher structural growth as you're looking at multi-year megatrends of 5G and high performance computing, or HPC. And so if you're not familiar, Taiwan Semiconductor is one of the largest independent foundries making computer chips in the world. If you're interested and you think I should make a video on it, feel free to leave a comment below, hit that thumbs up button. Maybe I'll do so on this YouTube channel. And so I look at this, and when you have a company say, hey, here's why we're going to be growing. And by the way, they're growing 50% this year, and they trade at around that teens earnings multiple that gets Berkshire Hathaway interesting. It's interesting to see, oh, this fits the criteria that they themselves are calling out. This fits. And they're saying, hey, Apple's going to need more and more powerful microchips in their phones. They're going to be getting smaller. There's going to be more demand. This company historically showed some pricing power. So this company will likely be bigger over the next 5 years. And you want to say, hey, do I have high confidence that this will happen? Now, it's important to step back and recognize with step one, there's some limitations there, because you're effectively saying, hey, I want this 15% cutoff. Maybe you say 20 times earnings multiple. Either way, you're setting a threshold where you're going to be removing a lot of companies that trade at higher multiples, maybe 25, maybe even 50 times earnings. The reason why those companies trade at higher multiples is maybe it's some perceived quality, or maybe it's because there's a lot of growth. So Warren Buffett is saying, hey, I'm not necessarily looking to pay for that growth because it's unclear whether or not future growth is delivered. So I want to focus on getting my returns now, my 6-7% at least a year, plus whatever, sort of at a minimum growth I can expect. And I also want to find situations where I'm highly, highly confident, 90% confident that they will be bigger in 5 years from now, earning more money. The third step ties it all together and says, hey, can I say with, let's say, a 50% confidence interval that this business will compound at 7% over 5 years? Now, I think that 7% is pretty low. That's, the 40% target, that's in line with, let's say, the major indices over time. Historically, Warren Buffett is targeted closer to 10 to 12%, which is, closer to that, 60 to 80% returns over time that investors obviously are looking for 10 to 12% or more over time. Personally, I'm looking for more than that as I consider any new investment that I want to, make a purchase in. And so when you think about that 7%, that factors in everything. That factors in the first component, which is valuation. It next factors in the fundamentals. Are the fundamentals growing? And then next it factors in that third component, which is the cash flow. And that also sort of judges management. What is management doing? Are they returning cash flows, and how to think about this? If all this is a little bit confusing, thinking about the valuation framework, once again, I do have a video, an exclusive course series dedicated to valuation analysis as well as financial statements, which you can check out at Unrivaled Investing. And so I think it's really important for investors to consider that there are these three components: valuation, fundamentals, as well as cash flow. And how do you tie all three of those together when you're trying to say, hey, what's my actual return? And do I get that 7%? And when you look at some of their historic investments like Apple stock, you can see, yeah, they bought it around 2016 when it was trading at a low teens earnings multiple. Then you had effectively investors wake up, say, hey, this is actually a company that's still going to be growing. It's still an exceptional business. And so you had a few things happen that drove a 400%, previously closer to 500% return over just a few years, which was you had the earnings power, you had valuation expansion. So as you had the valuation expand and you had the earnings power expand, you saw significant re-rating in the stock price. And it was actually a third component as well. What did they do with the cash flows? And they were buying back lots of stock. So that actually hypercharged their earnings power. So even if, let's say, fundamental earnings only increased by 5-10% a year, if you are also buying back 5 to 10% of your stock each year, now you're looking at earnings increasing closer to 20% a year. Then when you double your valuation, like you saw, you see you're going from low teens to 23 times, then you're saying, oh, all that earnings power, yeah, we're doubling it. So we're effectively, there's a multiplier effect because you have the valuation expansion. So this is why Apple turned into such an exceptional investment, and it's now the largest part of their investment portfolio. Now, I think it's really important for investors to consider running a screen like this is actually quite easy. You will get lots of different companies, and one should recognize this is the hurdle that they're using. They have much more money under management, hundreds of billions of dollars. Size is your advantage. And so what I would personally do if you're looking for investment ideas is to look for companies that have, let's say you're using a higher hurdle rate, saying, hey, I want to find something where I can more easily pencil out 10 to 15% over time. And, if you're going to say, hey, I want to, assume, let's say, a higher earnings multiple to start with, I want, maybe instead of 15 times earnings multiple, I'm willing to accept 20 or 25 times. You need to have a lot of confidence to say, hey, this business for sure is going to be growing much faster in the years ahead. And that's obviously very tough to do. Now, I personally call out a few of these types of companies that meet the Buffett sort of three-step process, with my letter that I call out to my Unrivaled Investing subscribers at unrivaledinvesting.com. For example, there's a company called Global Payments that I called out, and that also, it pops up on the screener, here it is. I was looking for companies under 15 times next 12 months. I did a video on that. So you can see companies like that, KKR, the major investment firm. That's another, company that I talked about, with my subscribers at unrivaledinvesting.com. And so it's important to, I think, turn over those rocks for the companies that meet these three steps. That is the Warren Buffett hurdle that he currently uses for managing his investment portfolio. If this educational video talking about Warren Buffett's three-step approach to finding exceptional investments, if it's been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching.